guys can.
Is it afternoon where you are, Sheikh? We can see you and hear you.
Right. All right, guys. So this afternoon, don't worry about that. So, can you guys hear me? Hear me? You can hear me, right?
Yes, we can. And the candidates have confirmed they can hear you. Please go ahead. You
All
have
right.
the floor.
All right. All right. Thank you so much, guys. So this is quickly shared some topic weights with you guys, right? You know, your level one is about 10 topics. These are not a sacrosanct weight, but this is just something that it's within a range. You know, the weights are usually a range, right? So within a range, you know, your functional areas are now four. You have ethics and professional standards. You have tools. You have professional management analysis, and you have assets. So if you look at it, these are just a general thing there. So you see that your weight, if you check FRA, look at your equity, look at your ethics, your fixed income, your corporate finance. They carry a lot of weight, right? So it's about 60%, and your economics cons is about 20. So this doesn't mean that you should not focus on all the topic areas or functional areas, but just for you to know the weighting, right? These are like a band. It can move up and but on average, this is how it is. So before we start, I would like us to take some quiz, right? Then we can quickly check some of the topics in FRA. The quiz are like 14, 15 questions. So you can type your answers here. Then I can see. So you can see some of the areas that you guys are having issues with. So your FSA is mainly divided into three, right? You have the first one that is giving you introduction of financial analysis and financial reporting. The second one is just the financial statement everywhere. Your income statement, your balance sheet, your cash flow, and your financial analysis techniques, right? While your number 3 and 4 is mainly on the key topics in FRA and how those things can be reported. You know, your FSA has both standards, IFRS and US GAAP. So for inventory, for long-lived asset, for income tax, what are the standards saying? Like what is IFRS saying on this? What is US GAAP saying? And what are the differences? So these are the testable areas that I believe you are going to see in your exams, right? So now let's go quickly to the quiz. Let's see. S to 5. I don't expect the quiz to take us more than 30 minutes, right? So I want you guys to be fast. Type your answers there. Then I'll give you the answers. And if you have any questions, let me know. All right, that's the S5. Fastest finger first, the SC. I want to see you guys stuff there. Yeah, let's see what you guys have. I'm checking the answers here, right? No, don't give me one after the other. Like, if you want to type the O5, because I want to see who can get the highest scores. Just give me the O5, put it there, then you will see where you get it wrong. All right, so Joy has given me the 05. Osas2 has given me the 05. That's fine. Okay. Buba has given the 5 too. Right. Okay. I can see. Now, let me give you guys the answer so that you don't waste too much time here. Guys, those are the correct answers. Number 1 is C. So who got everything? Number 1 is C. Number 2 is B. Number 3 is B. Number 4 is A. And number 5 is B. I can see that some of you got some things wrong there. Let me quickly run through this. These are the things you should expect in a standard CFA exam, right? Look at that number 1. The number 1 is asking you that which of the following best describe the role of financial statement analysis, not the role of financial statement analysis. Why do you do analysis? The reason why you are doing analysis is actually to form an expectation about the future performance and financial position of the company, because you want to invest in the company's future. You are not investing because of now. And if you remember, what do you do about fair value, right? It is, so the price of any company, the share price of any company today is the present value of its future income, discounted today, right? So why you are doing analysis is basically because you want to form an expectation about the future prospects of that company, whether you want to invest or not, right? So the number 2 is saying the role of financial statement analysis is best described as, just like I said, you want to make an informed decision. You are investing, so it is an economic decision, right? The number 3 is just telling you that providing information about the performance and financial position of a company, so that user can make information best describe the role of what is still the financial reporting. Reporting is providing. Analysis is that you, as an analyst, you want to make an informed decision. See, look at that question. See, it's easier for you to get confused. The question said providing information about the performance of a company and the financial position, so that users, the people that want to use it, can make economic decision. It's called financial reporting. It is when you do a financial report, it is when you are providing the performance of that organization, so that users can now do analysis to make an informed decision. All right, so your number 4 is saying information about management and director compensation are least likely to be found. You would definitely find the management and director's compensation probably in notes to the financial statement, yes. You also probably find it in the proxy statement, but you would not, the list where you find the managers the management and director, the least place that you're going to find their compensation is in auditor's report, right? That's the least place because the auditor's report is not expected to report on the compensation of the directors. So you guys need to be careful about that. Least likely, most likely, and see, look at it from 1 to 4. I can see that some of you missed some, right? It is because it is not that you don't know it, right? But the issue is you did not read the question properly. Like the number 1, the answers easily tell you what financial statement is, right? But the question is asking you for financial statement analysis. So they will be putting all these things there so that it might confuse you, right? So, but be careful. Look at the number 4. They said least likely, not most likely. Now, number 5 is saying about information about the company's objectives, strategies, and significant risk are most likely to be found. Now, see, this one is not saying most likely. Where are you going to find it? Most likely you find it in the management commentary. Because when you see financial statement, right, the first page or the first few pages, you see the chairman's statement and the director's statement. That's where they talk about what has happened, but they will most likely emphasize on the future and the direction of the company. So this is one of the most important parts of financial statement analysis, right? Because you want to see or you want to feel the thinking and the direction of people that are running the organization. Remember, your financial statement is just reporting past performance of the organization, where the organization is as of today. However, as an analyst, you want to make an economic decision and informed decisions based on that past performance to be able to see whether there's a future with the organization, whether you want to invest or not. And that is why your FSA is one of the easiest, in my opinion, one of the easiest topic area that you guys should pass very well. I want to report a financial statement based on a particular set of standards. Now, if I want to report revenue, I have IFRS 15 there. If I want to report inventory, I have the standards that give us the guidelines on how to report it. So that is what the exam is going to test your your ability on. Let me put it that way. Ability to master those standards and how to apply them. So if I want to report inventory, how do I report inventory? There are various types of cost flow information or assumption. Do I want to report it as FIFO? Do I want to report it as LIFO? Or do I want to report it as weighted average? So you as an analyst, you will pick the financial statement of that company. They will have given you the information on how the standards were applied to be able to arrive at that financial report, right? So you will not take that information and be able to analyze. So as an analyst, you should be able to understand all these set standards. And that is what you will be tested upon. All right? Let's go to the next ones. Yeah, the number 6 to 9. I'm going to give you 5 minutes here, maximum. Let me see your answers. And if you have any question on what you have done so far, you can type it, right? Let me know. Type your questions there. I can take them along the line. I just want to test your stuff so I can see that you guys have actually of course, you must have read, but now this time period is how to be calm and distill the way the questions are going to be structured. You will see that you miss some of it because of some particular stuff. So now I expect you to improve upon that, right? Yeah. So I will also advise you guys, ensure that you treat as many questions as you can lay your hands on. It is not enough to master the whole thing, but you should be able to also understand how the questions are being structured. Please, huh? I want you guys to give me your full answer. Just put it there, 6, 7, 8, 9. What do you have? Two minutes more. All right, guys, one more minute. I can see a lot of answers, and actually, I can only see few that get everything right. I can see just few, maybe 1, 2, or 3, right? Guys, you need to solve a lot of questions. And I think from the feedback that I've gotten in the last 2 boot camps, probably we need to change it to only question and answer, probably a mock. Yeah, mock, yeah. I think you guys are good in conceptualizing the concept, but when it comes to answering of questions, it might be a bit tasking, right? All right, these are the answers. I'll put it there. Number 6 is C. I can see some of you picked A. Qualified opinion cannot be a preferred stuff. Remember, auditors express an opinion on the reasonableness of the preparation of a financial statement to see whether it's free from any material misstatement and whether it was prepared in free manner, right? So whenever you have a qualified opinion means except for. They are saying that everything is fine except for this. You know, there's a quadrant, right, that you can use to remember that if there's in the statement, will it be adverse opinion, will it be unqualified opinion, or will it be qualified? Qualified opinion usually except for opinion. Adverse opinion are negative, right? But unqualified opinion, they are the clean opinion, and that's the preferred one, right? Then the next one, it says, according to the conceptual framework of financial reporting, which of the following is not an enhancing? You know, we have two major qualities of financial statements: relevance and faithful presentation. Those are the two major ones. Then we have other ones that are enhancing qualitative stuff, right? Which are timeliness, comparability, verifiability, and understandability. Accuracy is not there. It's not there, right? Accuracy is not an enhancing qualitative characteristics, right? So the next one is saying, which of the following is not a constraint on the financial statement according to conceptual framework? It is not a constraint. You know, we have one of the major constraints, or two major ones. They are cost benefit analysis. So they want to see the cost that they are spending and the benefit of presenting that information. So it's a constraint, right? And the other one is, how do you balance, or how do you avoid omitting some critical material information? So the number B and C are actually the constraints. Understandability is part of enhancing quality, right? And the last one says that the assumptions that the effect of transaction and other events are recognized when they occur and not when cash flow occurs is called what? Everybody should hear this, right? It's your accrual basis. Yeah? You can type any question that you want. All right, let's go to the next one. This one, I'll give you like, yeah, let's say it has some calculations there. Let's see. Let me give you like 10 minutes here. Just type all your answers there. Then he will see who scored the highest, right? In this. Orindamola, it seems she just joined, right? We're on this quiz, right? So you can do your own as well. We have 3 minutes more to finalize it. Yeah. Yemi, are you also trying to attempt the quiz?
Are you trying to throw me under the bus again, Shegun?
We can never say, let's see if we still remember the concept, huh?
We'll take it in the faculty room.
Okay. I mean, maybe after this thing, yeah, we can do it again, right? I'm thinking probably he should do another one that's going to be a physical one, right? After this.
Absolutely. It's in the
And I
works.
want
It's
it
in
to
the
only
works.
be question and answers. What I'm seeing here is
Yes.
not encouraging. I can tell you. It's not
We'll
encouraging.
work on it.
Yeah.
That's very fine. Thanks.
All right, guys, 2 more minutes, please. Kuba, don't worry. He can send the questions to you. Some people will be on ground. We can send the question to you guys that are there as well. Some will be online. You will definitely find a way around it. I just want it to be basically on question and answer, right? Maybe by the time you guys do like 200 questions, you will sweat and go home and be very fine. Yeah, it's fine. One more minute, guys. One more minute. I'm sending the answers now, right? That's it there. So number 10 is A. What is the issue here? If the inventory unit costs are increasing from period to period, a LIFO liquidation is most likely going to result in an increase in gross profit. Is just given. The point is, remember, LIFO is an inventory cost flow assumption in which the last price is your cost of sales. Note that. Last price, that is the recent prices, are the ones that you're going to use to calculate your what cost of sales. Meaning that the prior prices will be used for your what inventory. So if you are liquidating, it means that you will be liquidating your prior inventory that has lower prices. Then that will give you high gross profits. That's it. Number 11, he said carrying inventory at the value above its historical cost will most likely be permitted. Where? Yeah, liquidation is the key word, yes. Because, and that is why I'm saying, you guys need to understand and see, be calm in understanding the questions asked. I think there are 3 layers to this exam, right? The first one is you have to understand the concept. That's the first one. Number 2 is that you have to be calm enough to understand the questions, right? And then the number 3 is now personal to you. You have to have that mental toughness to be able to withstand the rigor of that exam, right? So most of you, I can see that the concept is okay, right? But it's just answering the questions. And that is why I'm just thinking straight that next one, you guys are going to pass, you'll be in level 2. Level 2 will not be us coming and explaining the concept to you again. We will use the question and answer to re-explain or to revise those concepts, right? So it will mainly be question and answers, right? So it's saying that number 11 is now saying that carrying inventory at the value above historical cost will most likely be permitted. If what? The inventory was held by a producer of agricultural produce. These are the things that you see in these standards, right? They are there, right? I will also show you the difference between, as part of the revision of the key concept, I will also show you the difference between the standards, US GAAP, IFRS in terms of inventory and stuff, right? Number 12, we said Eric used bookstore, prepares his financial statements in accordance with IFRS. Inventory was purchased at 1 million, later marked down to 550. One of the books, however, was later discovered to be a rare collectible item, and the inventory is now worth an estimated 3 million. The inventory is most likely to be reported on the balance sheet at what? Number 12. Accordance with IFRS. Why? Can you just, I just want to tap your brains, right? Because this is supposed to, because I will still ask you in 2 ways. Now, let me ask you, if it were to be US GAAP, how much will Eric record that inventory as at the balance sheet date? How much? Why? Tell me why. Why? Why? Tell me why. Thank you. Because no reversal is allowed under US GAAP. However, the reversal is allowed under what? IFRS. So that means that the guy can actually write up his what? Inventory to 1 million. These are the questions you should expect. The exam will not be tougher than all the questions that you have seen there. I can tell you, they can't be. They just want to test your mastery of the applicable standards. That's all. It will not be other than this. However, you might mix it up. Somebody in the exam without a mental toughness can pick 550 because his brain might be saying US GAAP instead of what? IFRS. These are the things. And they can even be asked in another way that under your income statement for that period, how much are you going to record as a loss, or how much are you going to record as, according to your, because if there is no reversal, you must take the hits in your P&L for markdown in US GAAP, right? For IFRS, same way, you make allowance of provision, but you can only write up to the extent of the provision previously taken, right? So these are the things. All right, number 13, it says, Fernando's pastor purchased inventory and later wrote it down. Somebody's asking me for answer for number 11. I've said it. It's even part of what I've had there. Number 11 is A, right? He said Fernando purchased inventory and later put it down. The current net realizable value is higher than the value when hitting down. Fernando's inventory balance will most likely be what if compared? It's A. It will be higher if it complies with IFRS. It's given if you have written it down. And the net, remember, it said that your inventory should not be higher than the net realizable value, right? Said the current net realizable value is higher than the write-down, right? Inventory is recorded as a higher of net realizable value. So he said, Fernando balance, according to IFRS, if it complies with it, is higher if it complies with IFRS. Number 14, I think he should stop at number 14 and quickly talk about the concept. A write-down of value of inventory to its net realizable value will have a positive effect on what? On your inventory turnover. Because if your inventory has dropped, it means that the denominator has dropped. Then it means that your inventory turnover is going to be what? Higher. So you're going to see some efficiency in that angle. Now, before I move, any question in this area so far? Any question from what we have said so far? Any question? All right, in the absence of none, these are the answers here. They are there in the slides. All right, so let's quickly look at your financial statement and analysis. What do you need to know? What are the rules of financial statement and financial statement reporting and analysis? Number one, you want to evaluate an equity investment for the inclusion into your portfolio. You want an information about the company's performance, changes in their financial position, so that you can make an economic decisions. These are the things that we talked about during the question and answer, right? It now says somebody is asking a question. Hold on. Say, explain number 12 again. For number 14, does that imply there is a negative impact on the rest? Let me quickly go back to these questions as you guys are asking. Number 12, he said I should explain number 12 again. So number 12, if you are complying with IFRS, if your net realizable value is lower than your cost, your inventory is carried at the lower of net realizable value and cost. Then it means that you need to write down your inventory to your net realizable value. Now, if after some time, the net realizable value now becomes okay, maybe it moves to the cost or is even higher than the cost, IFRS is saying that you can only write it up onto the extent of the historical cost that you are, or to the extent of the write down that has happened in the past. That is why IFRS, if you are complying with it as per number 12, you will go with what? 1 million. But if it was US GAAP, you only take 550 because US GAAP does not allow reversal. That's that. Number 14, Brandon is saying it does not apply. So they say a write down of value of inventory. Yeah, see, if you write down your inventory in your balance sheet, what happened to your asset? Your asset is going to drop. So that means that it will have a negative impact. If you write down your inventory in your income statement, it's going to be a hit because it means that you are going to debit P&L and credit your provisions account, right? So those are negative stuff. But because of the write-down, your inventory turnover ratio will improve. So that is the only positive effect that you can see from an inventory write-down. All right, so that's that. Let me quickly go back. So we were on roles of financial statement reporting and analysis. So we are saying that these are the various roles that financial statement can play. It can help you to make an informed decision. It can help you to evaluate equity that you want to include in your portfolio. It can help you to evaluate any mergers and acquisition. It can also help you to evaluate an operating division, a subsidiary, or a parent company. It can even help you to determine the credit worthiness of a company. It can help you to decide whether a venture capital or other private equity investment is fine. Even it can help you to see whether you want to extend credit to a particular customer or not. It can help you to assign debt rating on the bonds. It can also, the most important one, in my opinion, it can help you to forecast the future prospect of a particular company in terms of their cash flow, net income, because these are the things that will make you to make an informed decision. So what are the major financial statements that you have? You have your balance sheet, you have your income statement. Remember, your balance sheet is assets, and the other side is your liability and owner's equity. This is the accounting equation, right? But I can tell you, in fact, under your corporate finance, this equation is what you should have in your head. This side, assets, is telling us that for every asset that is owned by a company, it must have been funded by either liability, which is debt, or equity. This liability and equity, that is your capital structure in corporate finance. That's your capital structure. That is your capital structure 70-30, 40-20, 40-60, 50-50. What we are simply saying is that your capital structure is saying that what is the debt element that you have and what are the equity elements that you have to be able to fund these assets. So that is why you see all your ratios point towards solvency ratio, and some are also asset efficiency. How efficient are you using this asset that you have? And how is your ability to be able to pay your debts as and when they become due? Right? So this something that you are having is mainly your what? Capital structure. Asset equals what? Liability and equity. So your income statement is mainly your revenue plus your income minus your expense. Then you have your comprehensive income, you have your changes in equity, right? So also you have your cash flow. Your cash flow is mainly divided into three: your operating cash flow, your investing cash flow, and your financing cash flow. So your operating cash flow is just telling you the effect of the transactions that involves your normal business, right? While your investing is talking about your acquisition, your sales of PPE, your subsidiary, or your segment. While your financing cash flow is just talking about your debts, equity, dividend paid to stockholders, right? Can I ask a question? Under IFRS, interest paid, interest received for operating under cash flow, how do you report it under IFRS? And how do you report it under US GAAP? Can somebody quickly just tell me? Because I'm just stopping you guys, by the way. All right, let me just go on. When I see the answers, I can comment on them. So because we don't have time. Yeah, I can see operating of financing, operating all this, operating all this. So what is the major stuff, right? What is the major difference between US GAAP and IFRS in terms of interest paid and interest received? All right. US GAAP, everything is under what? Operating. However, there's a flexibility under what? IFRS. It can either be reported as investing or operating. Note this, please. Note it. It will come out. Yeah. All right. So, financial statement notes is there. These are the notes that we talked about when we were doing the stuff. This will give you all these accounting assumptions that were used, the methods, and can even give additional information about the acquisition during the year, disposals, and stuff, right? Then MDAs, that is your management discussion and analysis. They will tell you about the future, forward looking. See, as an analyst, the major reason why you are looking at the MDAs is just to see the direction of the company, to understand the mindset strategy, or people that are running the company on your behalf, or as a potential investor, right? So you can also file that. You'll see these are the things that you can check. All right. So audit reports, you can also sit down on there too. Then the audit opinion can be qualified, just like we talked about, can be qualified, unqualified, adverse, or disclaimer of opinion, right? What is disclaimer of opinion? Can somebody just quickly give me anything on that? All right, guys. So, yeah, thank you. I hear you. So there is scope limitation. So please note, what can give you an opinion or an unqualified opinion can either be because there's a scope limitation or they are not compliant with all the accounting standards. So I can see that you guys, just like I've predicted, you guys are very good with conceptualizing the concepts, but now you need to understand how to put this into question and answer, please. Don't, because your pass affect us in this thing, right? So you guys need to pass. All right. This is the summary of the financial statement analysis framework, right? Number one, what is your first phase? You want to articulate the purpose and the context of the analysis, right? So what are the information that you are looking for? Communication with the client, institutional guidelines, the nature of the analysis. So what is the output, your statement of objective, SOP, your list, nature of this. So the next phase is you have to collect your input data. What are the things that you want to collect? All the financial statement, discussion, the output will now be an organized financial statement, financial data. Then you process it. This stage 3, where you process all the data that you have collected. Then your output will now be you having your common size ratio. Remember, your common size ratio is an item in the P&L, in the income statement or balance sheet as a percentage of revenue or assets, right? Then you can do your forecast, you analyze, you develop your own. Maybe you have taken out some stuff. Then you can make a recommendation. Follow up, you can update your report and recommendation. So that's that, right? Now, these are the financial reporting standards. Everything that we have been talking about, that we've talked about, IFRS, US GAAP. I will not bore you with this. I'll just go straight. So before I go straight to this thing, remember, we have the qualitative characteristics, right, of financial reports. And I mentioned it, there are two, right? One is relevance, the other one is faithful representation, right? One is relevance, the other one is faithful representation. And the enhancing qualities, just like I said, are comparability, verifiability, timeliness, and understandability. Constraints on financial reports, we saw it in the question, is a cost-benefit analysis, omission of non-qualifiable information. It means that you might omit some, or you are trying to balance to ensure that you are actually reporting material information and not omitting any material information. All right, so the next one is I don't want to, so yeah. All right. Yeah, now what are the elements of a financial statement? We've talked about that is the assets, liability, equity, income, and expenses. Now, measurement of financial statement elements. You can measure your financial statement at historical cost, amortized cost, current cost, realizable cost, present value, or fair value. Can somebody quickly tell me which, don't worry, let's just go. Don't let me, we are pressed with time. I don't want us to spend so much time. So what are the ISB general requirements for financial statements? So your required financial statement are your balance sheet, your statement of income, your statement of change in equity, statement of cash flow, notes to accounting policies, etc. What are the general features? Number one, it has to be fairly presented. That is fair presentation. Going concern. It means that you are preparing your financial statement as if the company is going to be in future. That is, they will be operating. They will be in business the foreseeable future. Accurate basis is what we have talked about. Materiality and aggregation. Don't aggregate any item. No offsetting, frequency of reporting, comparability and stuff. So the structure and context, that you can have your classified balance sheet, you can have a specified minimum information on it, but you should have an information that flow. And you should also have a comparative information. That is, you must present the prior year's information. Now, this is where I'm going to, right? This is the difference between IFRS and US GAAP, right? Before I go to that, I have a summary of IFRS disclosure. See, when you are disclosure of accounting policies, you should be able to tell us the measurement basis. Guys, just give me a minute. Let me take some. Okay, don't worry. Let's go. You said significant accounting policies used. We must disclose it. Measurement basis. Measurement basis used in preparing the financial statement. Judgment that you have made in applying the accounting policies. Now, the source of estimation and certainty. What are the key assumptions about the future? These are your disclosures, right? Now, the difference between IFRS and US GAAP. US GAAP is mainly on rule basis. IFRS is principle. Inventory valuation, LIFO, FIFO, weighted average. IFRS, FIFO, weighted average. Extraordinary items are shown on the bottom of your income statement for US GAAP. They are not segregated when it comes to IFRS, right? Development cost, you treat it as what? Expense under US GAAP. But for IFRS, you can capitalize if and only if some conditions are there. What are the conditions? That this is going to bring in a probable or future inflow of economic benefits, right? You have the intention to use that asset or sell it, right? The cost can be reliably what? Measured, right? Technical feasibility is there, right? So these are the conditions. Now, under inventory, just like what we have, reversal of inventory is prohibited US GAAP, but it's permissible for IFRS if some conditions are met. Any questions so far? Before I move to income statement, type your questions there. Any questions so far? Any questions so far? All right. In the absence of that, remember we talk about your income statement, right? Your income statement is basically your revenue plus your other incomes minus expenses, right? That is what you are. Yeah. So your revenue, there are 5 steps. You must be able to identify the contract with the customer. You must be able to identify the performance obligations in the contract. You must be able to determine the transaction price. You must also be able to allocate the transaction price to the performance obligation in the contract. Now, see, recognize revenue when the entity satisfies a performance obligation. Remember, the revenue are only recognized when it is earned and realized. When you've earned it, that is when you can what? When it is earned, that is when you can recognize the revenue. All right, because your questions are distracting me. So I'm thinking about them, I'm looking at it. So I will answer, I'll take 2 minutes to look at your questions and answer them, but just keep it coming, right? So that's that. Another thing you should understand is matching concepts, right? So you must be able to match your cost with your revenue, especially inventory. Your cost of goods sold in a particular period must be matched with the current period revenue. Other costs such as depreciation, administrative overhead, they are just periodic costs that you must recognize whether revenue is generated or not. Now, depreciation. What are the types of depreciation that you have? Straight line. That is, we're just doing an equal amount depreciation expense in a year up through the useful life of the asset, right? Declining, that is when you are using higher value at the earlier stage. You will be asked, let me ask you this. Whether you use a straight line or double or declining balance, sometimes we call it reducing balance method, where depreciation in the early years of the assets are higher than the later years. But for straight line, is flat all through. Now, let me ask you this. Whether you use a straight line or declining balance, will it change the total depreciation of the assets? Same, right? Now, which one is preferable in terms of which one will give you a higher profits at the early years? Is it when you use a straight line or when you use a declining balance? Straight line will give you a higher, okay, good. See, these are the things you'll be asked. So be calm when you see those questions. Least, most, be calm. Now see, you have given me now that this is going to give you, straight line will give you a higher profit. Giving you a higher profit means that whatever value you are using that profit to calculate in your ratio, you need to be careful to see whether it's at the numerator or at the what denominator. So now, if somebody now asks you that, which one will give you a higher cash flow at the early years? Each one will give you a higher cash flow. Straight line or declining? Double decline. Actually, yes. So that means that your operating cash flow will be higher. These are the ways you should be able to distill the questions. So if your operating cash flow is higher, or your total cash flow is higher, so that means that all the ratios that you're going to calculate based on that is going to be what? Favorable. Expect questions where they'll be comparing these things in terms of IFRS, US GAAP, or comparing straight line, FIFO, LIFO. Please, and be careful, just calmly distill it and see the ones. You can even give it some numbers in the exam, right? Since you know that double declining is going to be higher, you can give it like 2. Straight line, you give it 1. Then whatever ratio that you are asking for, plug that one there and use a constant value for the other variable. Then you will be able to do that, right? And that's it, right? Yeah. All right. So summary of inventory costing method. FIFO means test out. This inventory costing is talking about your cost of goods sold, right? Then it means that the opposite or the other leg is going to be your inventory. So if I'm using FIFO to do my cost of goods sold, it means that during the period of relatively high pricing, like what we're experiencing in Nigeria today, that means I'll be using the cost of goods sold of goods bought last year, which are lower in pricing or prices. So that means that my cost of goods sold is going to be lower. Then my profit margin is going to be what? Higher. But what will happen to my inventory? My inventory is going to be what? Higher. If your inventory is higher, what happens to your inventory turnover? As compared to LIFO, it's going to be lower. So these are the ways you should think about it. Juggle it in your mind, right? Right? And so LIFO is using latest prices now. It means that my gross profit margin is going to be what? Lower. Right? But my inventory is going to be what? Lower as well. Then my profit margin is going to be what? Lower. Then my inventory is going to be what? Lower. Then my inventory turnover is going to be what? Higher. Then what happened to your taxes and cash flow? In FIFO, as compared to LIFO, in an increasingly inflationary increasing or rising prices, your cash flow is expected to be higher in LIFO because you're going to pay a lower what? Taxes. Yes, because your gross profit margin has already dropped. So your taxes is going to be what? Lower. These are the ways you look at it. Right? All right, but weighted average is going to be in the what? Middle. It's just going to be there. So look at the hider. They said, assuming no LIFO liquidation, LIFO layer liquidation occurs when the volume of sales exceed the volume of purchases in the period. So there are some sales that are assumed to be made from existing, just like the questions that we treated, right? Existing low-priced inventory, rather than from the more recent purchases are sold. So that means that you are going to make what? More gains. So that's that about inventory. Things that you can see there. If you have any question, if something is tasting, try to do as many questions as you can lay your hands on. And I can tell you, with the way I've explained this, juggling it in your mind, use Nigeria example. If I have two inventory, one was bought 2 years ago or a year ago, one was recently purchased, the one that was recently purchased is going to be higher, right? And the other one is going to be what? Lower. Just juggle it that way. Look at the ratio that you are being asked, right? Look at where the items are going to be. Will it be at the denominator or numerator? That will tell you whether the ratio is going to go up or it's going to come down. All right, now let's quickly go to assets. So let's start with intangibles. The intangible asset, they are assets that you cannot feel or touch, right? So if you cannot feel or touch them, we are saying that the ones that have limited useful lives, what you should do is that you have to amortize them over the period. Like somebody that was asking me a question about software, I will still come back to that, but I will, as soon as you have understood it, I think you should be able to get this right. And the other one is that asset that intangible that you that don't have useful lives. That is, they don't have a limited lives. Your asset can either be tangible or intangible. Tangible means you can feel or touch them, which are your property, cars, etc. Your depreciation method on those tangible assets can either be straight line or what? Declining balance. For intangibles that you cannot feel or touch, we have to also categorize them into two. Do they have a limited useful lives or they have indefinite lives? If they have limited useful life, it means that you have to amortize them. Amortization is the word, or is another word for depreciation that is being used for tangible assets. Then you amortize them over that useful life. But if it is an intangible asset with indefinite useful life, like goodwill, you do not amortize them. But what should you do? You test them for impairment annually, or whenever there's a reason to believe that they have been what impaired. All right. So other things that you can look out for in your during your stops is look at result of discontinued operations. They are usually presented like a pseudo line, net of taxes, below the income from continued operations. Also look out for unusual or infrequent items that are reported before tax or above continued operations. So as an analyst, you should determine how unusual or infrequent items really are for the company when you are estimating the future value. Also look at the changes in accounting standards. You have to check whether it's a prospective corrections, that is, the correction is going to take place from now till future, or if it is a retrospective, because if it's a change in accounting policy, it has to be applied, right? Retrospectively, as if the accounting policy has been in place since, right? But if it's just a change in accounting estimate, it has to be prospective. That is, it has to be from subsequent period, right? So also try to distill the operating income that is being generated from normal business operations, right? And the ones that are not generated from their normal business operations. Those are the ones that we classify as other income, right? Now, I know that your exam, they're going to test you on some ratios. There are two popular ratios that you should know. Profit margin, which is your gross profit divided by revenue. Net profit margin, it will be tested. Another one that you should understand is earnings per share. Earnings per share and diluted earnings per share to be tested. So note that when you are doing your basic earnings per share, it has to be your income minus your preferred dividend. Then the weighted average number of common shares outstanding during that year. But if you are doing diluted, it has to be your net income minus your preferred dividend. You have to add your convertible preferred dividend that has been paid, you add it back, and your convertible debt interest, add it back. But remember, take away taxes, right? Because it will no longer be tax deductible. Take away the taxes. Then all the shares from all these compatible debt or preferred shares, add it to your weighted average number of shares. So now they want to know, or the investors, they will want to know what is your dilutive, right? Because it can also it's also one of the major things that you use when you are making decisions, right? All right, so that's that. Then on your balance sheet, like you said, you have your assets, you have your liability, you have your equity. Your assets are one of all those things that we have talked about: your inventory, your intangible assets, your tangible assets, right? So your assets must be able to give you, must have a future economic benefit that is probable that will come into your company in future, right? And also, your balance sheet, you can assess it by the client's liquidity, solvency, and ability to pay. We are going to look at some of the ratios too that you should be aware of, right? Then under your balance sheet too, you have your liabilities, your bonds, you have your current and non-current liabilities, right? Under your current assets too, like I said, you have your inventory there, you have your PPE. Another thing you should understand under the difference between US GAAP and IFRS. Remember, when you are reporting your PPE, you can report under IFRS as cost model, that is cost minus accumulated depreciation, give your net present value, right? Or you use your revaluation model where you can revalue your assets. That one is allowed under IFRS. But under US GAAP, what is allowed? Only cost model. These are the things you'll be tested on, right? Only cost model is allowed. And he said that PPE, if it is impaired, PPE is impaired if its carrying value exceeds its recoverable amount. Recoverable of impairment losses are allowed under IFRS, but not allowed under US GAAP. You know your recoverable amount is the lower of fair value less cost to sell and value in use for IFRS, right? Your intangible assets that are created internally, they are incurred as expensed, right? So you expense them as you incur them. But for purchased intangibles, they are reported similarly to PPE. But for under IFRS, just like we have said, research costs are expensed as incurred, but developmental costs capitalized when those conditions that I earlier mentioned are there. But for US GAAP, both research and developmental costs are what? Expensed. Right. And also goodwill. Goodwill is an intangible with indefinite useful lives. What we said is that you don't amortize, but you test for what? Good impairment at least annually, or when there's a reason to do so. Under IFRS, you have debt securities with your intention to hold. What you will do is that you measure them at amortized cost. But the ones that you acquire with the intent to just collect interest payments, but sell before maturity, you measure them at fair value through other comprehensive income. But debts that you acquired with the intent to sell them in the nearest future, you measure them at fair value through profit and loss. I'll give you a summary of this financial instrument. You will see a table. When you get to level 2, we will teach you about this financial asset in depth, right? You know, as a company, you invest. So if you invest in another company and you own 50% or more of that company, so that means that that company is subsidiary to you. But if you only own 20% to 50% of that company, how do you report it? You report it as equity method of accounting. But a company that you own 50% or more, the subsidiary, how you are going to report them is going to be through consolidation. But an investment that you have that is around 10%, we classify them as financial instruments. This financial instrument can either be equity or can be what? Debt. So how do you report this? Mainly, you either report it through amortized cost, through your OCR, or you classify them as fair value through profit or loss. It means that whenever there's a change in value, they flow into your what? Income statement. Revenue, the interest also flow into your income statement if you measure them as fair value through profit or loss. So that is the summary of what I've mentioned to you. I will give you a table on that now. So under your balance sheet, so you have your account payables. I'm skipping the number 1 and number 2 because that is what I've just explained that your equity, that is your financial instrument, we can either measure them through OCI or through fair value, or fair value through profit or loss, right? OCI means that if there's a change in the value, it doesn't flow into your P and L. It goes to your OCI. But if you have elected to classify it as fair value through profit or loss, it goes to your P and L. All right, that's that. Your account payables too, they are your liabilities that you want to pay, or there's some of them are your unearned revenue. Remember, you might have done the job and the revenue has not been earned. Maybe because it's a contractual thing, you must complete a particular phase before you must earn the revenue. The revenue will go to your deferred revenue under your liability. So that's why we're saying under your liabilities section, you can have your account payables, that is amount that is due to your suppliers. You can also have your accrued liability, that is the expense that you've already recognized in your P or L. You know, whenever you are passing an entry, you have double entry principle. If you debit your P&L for the expense that you have incurred, but you are yet to pay, the other leg will go to your liability as accrued expense, right? That means you've already accrued for it, right? Then the other one that you can see under your liability is your unearned revenue. These are your deferred revenue, right? All right. So this is the table that I want to show you how you measure your financial assets. So the ones that are measured at cost or amortized cost, they're your debt security that you say you want to hold till maturity. Your loans and notes, receivables, and your unquoted, look at that, unquoted instrument in some limited circumstances there, yeah? But the ones that you want to measure through OCI, they are your available for sales, debt securities, where the business model simply involves collecting interest and principal and selling this security, or equity investment for which the company irrevocably elect to measure at that. So you cannot be changing. So the old standards you can change. So it was discovered during the 2018 crunch, right? Because companies really want to manage their profitability, right? So if they elect that this financial instrument is through profit or loss, or through fair value through profit or loss, and at the end of the year, it has dropped significantly in value, they will just say, oh, we are changing it back to available for sale. So they will not report that loss in P&L. Or if a financial instrument has increased in value tremendously, they will just say, oh, we are changing it to fair value through profit or loss. So they will record that gain in that year, and you will see the company's profitability so huge. So to avoid that, there was a changes in that financial standards. That was what gave birth to all this new financial standard on the financial instruments. And I said it must be irrevocable. That means you cannot say, I'm taking this as available for sale, and then I'm changing it. It's irrevocable. So the ones that you measure at fair value through profit or loss are your equity investment that you just say you are either holding for trading or you want to sell at any point in time. But look at that, sir. He said securities not assigned to either of the two categories or investment for which the company irrevocably elect as this. So if you have not elected as OCI or amortized cost, it comes in. Any equity investment that you just say you are holding to sell in the near future for quick gains, they come there. And that's it. So what are the balance sheet ratio that you should be aware of? Just like I told you earlier, the examiner is going to test you on some of these ratios. Liquidity. That's your current asset over your current ability. So this one measures your ability to meet your current liabilities. Your quick or acid test is your cash, marketable security plus receivables divided by your current liabilities. It's also measuring your ability to meet your current liability. And you also have your cash. Cash is just mainly your cash plus your marketable securities divided by your current liabilities. Other ones that measure your long-term ability or your financial risk, they are your total long-term debt divided by your total equity, your total debt divided by your total equity, your total debt divided by your total assets, and your total asset divided by your total equity. Expect this because this is also linked to your ROE, right? Right. We are going to talk about your ROE too, return on equity, using DuPont analysis. It was slightly mentioned in your curriculum here, but it's a huge topic under your equity in level 2. But that doesn't mean that the examiner might not bring 1 or 2 questions around this area. All right, so like I said, now the next one is talking about financial analysis techniques, right? These are doing your ratios, your vertical common size. Although you should be careful that your ratios has limitations, they are only useful. They are not useful when you view them in isolation. So that means you need to do different adjustments for different companies so that you can use it for comparability and stuff. But another thing is, what we normally say is that your analysis is as good as the bias of the person doing that analysis, right? So these are one of the limitations too. So you have to also be careful of your liquidity ratio that we just talked about when you're doing your financial statement analysis technique. Look at your activity ratio, your solvency ratio, your profitability ratio, and valuation ratio. Valuation ratio, I don't expect much to come for everyone, but I expect it to be a big deal in equity and FSA in level 2. Your profitability ratio, your gross profit margin, net profit margin, they are very key. All right, this is the ROE that I was talking to you about. The examiner will definitely test. I expect the examiner to test 1 or 2 questions around this area, your ROE. This is testing 3 stuffs, right? Which is your net income. This is your operating margin. So your ROE, this 3 is called DuPont analysis. The first one is talking about your operating margin. The next one is talking about your asset efficiency. And the third one is talking about your financial leverage. So that means that using DuPont analysis to calculate your return on equity, it means that is your operating margin multiplied by your asset efficiency multiplied by your financial leverage. Note, in the exam, the examiner might not give you all these variables, net income, sales, or you might be given. However, the examiner might be, you might be given some information that has this information already. Like the examiner telling you that company A has operating margin of 20%, a net asset efficiency of so, financial leverage of this. The examiner has already given you all the variables. But if you don't know the interpretation of the ratio, you will not be able to solve it. So what I'm saying now is this. The examiner is simply testing you on what? Operating margin multiplied by what? Asset efficiency and financial leverage. Those are the 3 combinations of your ROE. Now, another combination of DuPont analysis was now, we call it extended DuPont analysis, which now has 5. And you see, the first one is testing your what? Net income divided by your what? Earnings before tax. What is this first ratio talking about? Your tax efficiency. The next one is now saying earnings before tax divided by earnings before interest and tax. This one is testing your what? Interest. So what I'm simply saying is that the examiner might not give you all these variables to be dividing and stuff. You might just be giving a sum of the ratio for each of those brackets. Now, this one is saying earnings before interest and tax over your revenue. This is purely your what? EBIT margin. Then your revenue over your total assets, your asset was efficiency. And your total asset over your equity is your financial leverage. In essence, the first three is testing your operating margin multiplied by your asset efficiency multiplied by your financial leverage. Why the third one is giving you what? Tax, margin, interest, EBIT margin multiplied by your asset efficiency multiplied by your financial leverage. So you should be able to understand the interpretation of these ratios because you might not even see the, what is it called? The variables to calculate those words, the ratio, but you might just be given the end products of the ratio. Yeah. So that's that. So some of the ratios that you might be asking the exam is just your PE ratio, price to cash flow ratio, price to sales ratio, price to book value ratio. And your credit analysis emphasizes on coverage ratio, which is your interest coverage, right? Your return on capital, debt to asset ratio, and cash flow to total debt. So your segment is a portion of the firm that has its own risk. So the examiner might also be asking you maybe some the viability of some of the segments or the profitability of a segment in a company. That's that. So ratio analysis in conjunction with other techniques can make you to construct your pro forma financial statement. Then you can forecast your sales growth, have an assumption, change some things. Then you can be able to know the future prospect of the organization, of the company that you want to invest in. Now, the next one is taxes. There are different. So I'll tell you straight. Let me just tell you straight. When you are doing your taxes, the major one that can give you stress or that can be confusing is your deferred taxes. That is, you might be saying you have deferred tax assets or you have deferred tax liability. You might have read a lot of stuff and it might be confusing. You don't know if it is a deferred tax asset or if it's a deferred tax liability. But note this. This is just, I'll give you a two-liner. Note it and use it to solve any question and you will not miss it. I can guarantee you that. Look at this scenario. Whatever that is making you to pay lower taxes today, you are paying lower taxes today, but you will pay higher taxes in future. What you have simply done is you have deferred tax liability. That is, you have deferred it to future. I'm saying that again. Whatever that is making you to pay lower taxes today, but you'll be paying higher taxes in future, it is your deferred tax liability. From the English, deferred. That is, you are taking it to the future. You are taking that liability to the future. So look at it. Whatever that is making you to pay lower taxes today, but you're going to pay higher taxes in future is deferred tax liability. The next one, the second statement, whatever that is making you to pay higher taxes today, but you'll be paying lower taxes in future. That means you have a deferred tax assets. Now let's put it in this scenario. Let's say you have some impairments. I'm just giving you some example. Then you now say you have the impairment on assets of $10,000. You put it in your P&L, income statement. Then the tax authority said it is not qualified for tax allowable expenses. So that means that you are taking off that expense. If you take it off, what happened? Your profit will go up that year. Because it is going up that year, you'll be paying what? Higher taxes that year. But in subsequent years, when you eventually now sell that asset or that item that is giving you that impairment, then it might now be accepted as a tax allowable what? Expenses. At that time, what will happen? You'll be paying lower taxes. So what I'm simply saying is that whatever that's going to give you higher taxes payments today, but you'll be paying lower taxes in future, then that's a deferred tax asset. But whatever that is making you to pay lower now, but you're going to pay higher in future is a deferred tax what? Liability. A testable material or areas is the changes in that liability or assets. So if you are carrying a tax liability of, let's say, 10,000, you know, what you normally do is you look for that amount, multiply by your tax rate, right? If the tax rate should change, if it should change, let's say you are carrying 10,000, multiply by 20,000, 20% taxes times 10,000. That will give you what? 2,000. Let's say that's a deferred tax asset. Yeah. Then the tax rate changed from 20% to 30%. What does that mean? It means that you will have to recalculate your deferred tax asset, right? So it will now be 30% multiplied by 10,000. So that means your deferred tax asset will now be what? 3,000. But you are previously carrying what? 2,000. So that means your deferred tax asset has what? Increased. It's a testable material. But if it has dropped, so that means your tax liability, your deferred tax asset has what? Dropped. It will be an expense to your what? Income statement. This happened to Manchester United some years back, where they reported a huge profit, but it was mainly from a deferred tax asset point of view, because there was a changes in what? Tax rates in the United Kingdom. Also look at it from deferred tax liability too. If your tax rate has changed, it means that your liability is going to what? Increase. But if it increases, it will. But if it drops, your liability will also what? Drop. So if it increases, it means that it's going to be an expense to your P&L, but if it drops, it's going to be a gain to your P&L. So what I'm simply saying, I'm saying it again, whatever that is making you to pay higher taxes today, but you'll be paying lower taxes in future, that is deferred tax assets. And whatever that is making you to pay lower now, but you'll be paying higher in future, that is deferred tax liability. But if you are paying higher now, you pay lower in future, that's a deferred tax asset. And the changes in this deferred tax asset can happen when there's a change in tax rates. So a reduction in your asset is an expense, an increase is an income. And a reduction in your liability is an income, but an increase is a liability. All right. So if you look at the difference here, revaluation of fixed assets and intangible assets, they said it is not allowed. No revaluation is what? Allowed. Under IFRS, it will give rise to what? Deferred taxes. Like I said, you have to look at the direction of the question. Is it making them to pay higher taxes now or lower taxes? Undistributed profit from an investment in subsidiary. No deferred taxes for foreign subsidiary that meet the indefinite reversal. Deferred taxes are recognized unless the parent company is able to control the distribution of the profit and its probable temporary timing difference. Another condition that you must know for you to be able to have deferred tax asset or liability is that there is a timing difference. Timing difference. All right. So these are the US GAAP and IFRS. The third one is saying that undistributed profits from a JV, no deferred taxes if it's what indefinite. But IFRS said there is going to be a deferred tax as long as the venturer is able to control the sharing of the profit, and it's probable that the temporary timing difference will reverse in future. Like I said, when there's a deferred tax asset, the major condition is that there must be probable that the temporary timing difference will not reverse in future. All right. The undistributed profits from an investment in associate deferred taxes are recognized from temporary timing difference. Both IFRS and US GAAP agree that there will be deferred taxes. Deferred tax asset recognition. You have to recognize it in full and then reduce, if more likely than not, that some or all of the assets will not be realized. Recognize if probable that you have a sufficient taxable profit to utilize it. These are the conditions for you to be able to even recognize that deferred tax asset or liabilities. Tax rates used to measure deferred taxes, they have to be enacted. Those are the enacted tax rates only for both, but for IFRS, if there is a substantive enacted tax rate. Like I've explained, look at it there, I said deferred tax liability is created when an income tax expense is higher than the tax paid person return. Deferred tax liabilities occur when the revenue arises, but just note that definition that I'm giving you, look at the direction. If you are paying higher now, you'll be paying lower in future deferred tax asset. If you are paying lower now, are going to be paying. If you are paying higher now, you're paying lower in future deferred tax assets. If you are paying higher now, are going to pay lower in future deferred tax assets. If you are paying lower now, but you're going to pay higher in future deferred tax liability. All right, that's that about it. That's everything that we've. So your other non-current liabilities, these are your bonds. Expect some questions here. Your premium bonds, it is when your coupon rate is higher than your market yield at issuance. On your balance sheet, the value is going to be greater than the face value because you're going to amortize the premium over time, right? And the book value of the liability will be decreasing until it reaches its face value. A discount bond means that your market yield is higher than your coupon rate at issuance. So it means that the face value will be lower, but it will increase as it reaches its maturity. Interest expense includes amortization of any discount or premium at issuance. So whenever you issue this, you have to know that. So now, for a premium bond, interest expense is less than the coupon rate. Yes. The difference between the interest expense and the coupon rate is subtracted from the bond liability, so that we are going to be reducing it gradually until it gets to the face value. But for discount, the interest expense is greater than the coupon rate, and the difference is added to the bond liability so that it can increase till it gets to the face value at maturity. So when the bonds are redeemed before maturity, a gain or loss equal to the difference between the redemption price and carrying value of the bond liability at acquisition. That is the gain. So the gain or loss, it's going to be equal to the difference between the redemption price and the carrying value at that. So there there's also your finance lease and operating lease, right? I don't really expect, but there might be, right? So you can lease rather than you purchase outrightly because it's the cost of finance is lower. There are fewer restrictions and the risk of obsolescence is lower, right? So under your IFRS, your short-term lease, a leasee will report an asset and liability on the balance sheet, right? Both will be equal to the present value of the premium lease payments, right? But if you classify that, right? So, but for US GAAP, the lease is classified as finance lease if the benefit and risk of ownership has been substantially transferred to the leasee or as an operating lease, right? So, but for IFRS, if it is a short-term lease, the rent is just going to be reported on the income statement, no balance sheet entry. But if it's not a short-term lease, then as a leasee, you must take it as if it is your own. Then you will report it on the asset side and on the what? Liability side. But for US GAAP, it was clearly said that you must classify whether it's a finance lease or whether it's an operating lease. So if it's a finance lease, you would report it the same way as IFRS, which is saying that all leases categorized as finance lease except a short-term lease. But for US GAAP, if it is an operating lease, entire lease payment is recorded as what? Lease expense, while the principal portion will reduce the lease liability. So so just note this, except it's a short-term lease under IFRS, the interest expense can, except all the short-term lease, the interest expense can be reported on the income statement, no balance sheet, except that all other leases are treated as finance lease in quotes, right? So you report the lease as asset and what? Liability. But for US GAAP, you have to report it like IFRS if you have categorized as finance lease. All right, so that's that. I don't really see. So these are the ratios that we've talked about, your debt to equity ratios and stuff there. Now, your financial reporting quality. I expect you to have some questions here too. Because people normally window dress, let me put it how. One of the things you should understand is the aggressive reporting and there's what? Conservative. Your aggressive reporting, what are the examples? When you are capitalizing current period cost. But for a conservative, you are expensing the current period cost. Another example of aggressive is that you are giving a longer estimate to the lives of depreciable assets. What does that mean? It means that assets that are supposed to be for 5 years, you are saying that they are going to be for 10 years. It means that your depreciation expense is going to be what? Lower. If it's lower, it means that your profitability is going to be what? Higher. So it's an aggressive accounting. But conservative, it means that you are giving it a shorter estimate, maybe 4 years, like a double or a declining depreciation method, right? As against straight line. Also, aggressive accounting, these are the things that you should watch out for in the questions, right? That is what I'm saying here, right? So if we look at, and also in real life, higher estimate of salvage value. You know, when you are doing your straight line, you will say cost minus salvage value divided by the lives, useful life, right? So if your salvage value is higher, it means that your depreciation will be what? Lower. And then your profit margin is going to be higher. So that's an aggressive accounting. But for a conservative, you are giving the salvage value a lower salvage value, right? Aggressive accounting can also be like straight line, just like I said, while your conservative can be accelerated depreciation. Aggressive accounting might be when you are delaying recognition of some impairments. You know these things have been impaired, but you are delaying in recognizing them. But conservative, early recognition of what? Impairment. Aggressive, less accruals of reserves for bad debts. There's bad debts, you know, this your account receivables, most of them are greater than 365 days, but you don't want to take provision for bad debts. But conservative, you are taking more accrual for provisions for what? Bad debts. Aggressive accounting can also be when you are doing a smaller valuation allowance on your deferred tax assets. But a conservative is what? When you are doing a larger valuation allowance for your deferred tax assets. So these are the key things that you might be tested upon. But let's look at financial reporting quality. A higher reporting quality adheres to all the gaps, and it makes decisions to be useful in terms of relevance and its representation. Remember, the major qualitative characteristics of a financial report is what? Relevance and faithful representation. And the other enhancing qualities are variability, verifiability, understandability. What is the other two? Who else can remind me of the other two? Timeliness, yes. Yes. Another one, the last one. Comparability. All right. So be able to understand, so the financial statement has those quality, right? If it has that, then we are not saying that a quality of financial reported results are your earnings sustainable. You know, sustainability means that the earnings that you are reporting now is sustainable in future, not a short-term earnings, not because you have a short-term gains, not because you are reclassifying some assets. That's why you're having some gains, not because you have a changes in, let's say, FX now. Let's say FX. You know, FX in Nigeria now, all the companies are declaring losses, blah, blah, but take away the FX loss. Are you reporting an earnings that is sustainable? So a high quality earnings are high enough to provide the firm's investor with adequate returns that are sustainable in future. So there's a spectrum of your earnings quality from the highest to the lowest. One, your reporting is compliant with gaps, decision useful, earnings are sustainable and adequate. That is the highest. Then we move to the next one. Your reporting is compliant, decision useful, but your earnings quality is low. The other one, the report is compliant, the earnings quality is low, and the reporting choice and estimate are biased, like your choice of accounting policies, estimates, like you are using straight line, using longer useful lives with higher salvage values, right? And another one is your reporting is compliant, but the earnings are actively managed. You're managing the earnings. And the other one is that the reporting is not compliant at all, but the numbers presented are based on company's actual economic activity. And the other one is the reporting is not compliant, includes numbers that are fictitious and fraudulent. So why do we have low quality financial reports? Major reason: one, if there are pressure to meet earnings targets. You know, when you move in your career, you get to a point that you see that majority of your salaries or your income, let me put it that way, are based on the profitability of the company. Then this can put pressure on management to want to manage earnings, to want to report a good stuff so that their total or their benefits is not impaired. Or they want to manage the earnings because of their career. So they will say, oh, I reported so this. This is fantastic. Just like I said, increasing their compensation, improving perception of the firm among the customers and suppliers. So whenever there's all those things, it makes earnings quality to be low. So conditions that you can see that are often present when managers issue low earnings quality is motivation, there's opportunity, and there's rationalization. There is weak internal control. There is inadequate oversight by the board of directors. There is a wide range of acceptable accounting treatment that are among factors that may provide opportunity for low earnings rates. So, as an analyst, or some of the things that you might be tested upon, how do you think we can manage this? There must be a mechanism in place. There must be regulation. The oversight function of the regulation must be par. So audit opinion offers reasonable assurance that financial are free from material error, but does not guarantee the absence of error or fraud because they might pay the auditors, right? So the firms may also attempt to influence analysts, right? So you need to be careful about those things. The valuation that was used, inventory cost flow method, etc. Those are the things then. Now, how do you apply your financial statement analysis? Check the trend of the company's ratio, compare with the competitor, compare with the industry average, look at the future income and cash flow as projected by your forecasted sales. Check the credit analysis, use their financial statement to look at their earnings quality. Look at the potential attractiveness of their equity investment, compare it with other stocks, right? When they are using different accounting methods, check it with the other guys to check it with the comparability of what they have used in the previous year. Look at their LIFO ending inventory, adjust it to FIFO, look at their LIFO reserves too. When you are calculating the solvency ratio, you should estimate the present value of the operating lease and add it to the firm's liability to see how it will affect their balance sheet. And that's the end of FRA. So I want to take the next 15 minutes to take your questions. And also, you can check all these questions that we've talked about, that we did at the initial stage. Let me know which of the questions confused you and why. From 1 to 10, and you can type your questions there. So I can give you back your time to rest before the final stuff. Questions? We are on Q&A now. If you don't have any, I will assume that you are good, everything is fine. We can all go. Okay, so Fumi is asking for basic and diluted. So your basic is just your income statement. That is your profit for the year. Your net income minus your preferred dividend divided by your weighted average number of common shares outstanding for that time. Why you're diluted? Because it's dilutive, right? So that means you have to look at the financial statement of the company. Look for all the probable dilutive transactions that they have. The major ones are the convertible preferred shares. That is, they have a preference shares, that the holders can convert to shares in the nearest future. And they also have like convertible debt too. That means the debt holders can convert it to shares. Add it to the weighted average number of shares outstanding during the year. Then your numerator will now be all those income or interest that you have paid them during the year, which you've already subtracted from your income statement. So what you are simply doing, you are saying your dilutive, your numerator is all the benefits paid to all the holders of the company's bonds or shares, bonds or preferred dividend that are compatible to shares. So that is it. Ordinarily, your dilutive will be lower than your basic earnings per share, ordinarily. All right. Daniel is saying lease. All right. Lease is basically what we're just trying to do here is that IFRS and US GAAP. IFRS is saying, except it's a short-term lease, like your rent, etc. Every other one, take it as a finance lease, in quotes. A finance lease is just saying, so if it's an operating lease, if it's a short lease, the rent goes to your P&L. You put it in P&L straight. But if it is the other one, like a finance lease, we are saying that that lease is no longer a lease. You will take it as if you are the owner of the property. Do you understand? So you would take the present value of that lease amount as your assets, which will be depreciating. Then you will not take whatever you want to pay as your liability. This is the liability that you're going to pay on it. So both IFRS and US GAAP, they're kind of similar. They are the same, actually. It's just that US GAAP is just trying to define it as either finance lease or operating lease. Why IFRS has changed. IFRS 2 used to define it that operating lease and finance lease too, right? But they've just tweaked it and said only short-term lease, because they want to classify every other thing as what operating lease, right? Because these are like what companies can use as off-balance sheet, right? You will take a lease from someone at maybe 50 years. You just be putting the entire income. But in actual fact, you are the owner of the building. So it should be part of your asset with the corresponding what? Liability. But remember, for all the assets owned, must have been financed either through equity or liability. All right, so Kenna is asking that please explain the conversion of LIFO to FIFO. Okay, somebody's asking, so you guys are asking the same thing. You did not touch any concept on this. We touched, that is what I just explained now. All right, so on the LIFO, like you know, is your lasting hairstyle, while your FIFO is your first in hairstyle. So if you have a LIFO in US GAAP and you want to convert it to a LIFO, so what you normally use is just to check the LIFO reserves. You use the LIFO reserve to do the conversion. I think I put it somewhere here. You will see, hopefully today, when I have that time, I will share the slide with Gloria. You can send it to you guys. So you can use your LIFO reserve to convert your LIFO to what? FIFO. I think it's in one of these things. So same thing as your LIFO liquidation, just like I said, the blessing, your LIFO liquidation is converting your earlier, selling your earlier inventory because you have sales more than your current purchase. Let's say you have sales of 10 this month, and the purchases that you had, that you did this month were just 5. So that means your cost of goods sold, it will be that 5 plus the earlier 5 that you add. The earlier 5, they are going to have a lower cost, right? And that's it. All right. What is this one saying? Somebody has already answered you on that. Please, can you throw more light on inventory reserves, inventory ratio, LIFO, FIFO? Okay. I think you guys, this LIFO, FIFO is really giving you some stuff. Employee benefit, please. DuPont analysis, we talked about this. Share-based payment is part of the compensation for the company, right, for employees. What is this one? Yeah, this is like, yes, exactly. This is the DuPont analysis that I mentioned, right? I don't know whether you guys can see my screen. Somebody shared a screenshot of when you are giving the ROE, interest burden, EBIT margin. So all you're saying is just to multiply everything together, right? Because you might not have all these things. Can we solve question on DuPont analysis? Okay. If you have any question on DuPont analysis, it can be done in the next 5 minutes. I can do that. That can be done, is no issue. What I just want you to know is this. See, if you can still see my screen, this is your DuPont analysis. If you are given interest margin, it's just a multiplication. Multiply your interest margin by your sales efficiency or asset efficiency, multiply by your leverage, your financial leverage. That will give you this. But if you are given this 5, they will give you the interest, the tax burden, interest burden, EBIT ratio, asset efficiency, and leverage. Multiply all the 5 together, and that will give you your answer there, right? So the basic thing that I will advise is that you guys should just solve as many questions as you can. 2 hours, 2.5 hours might not be enough for us to be able to delve into all these things. But with what I've seen, I think our strategy going forward is going to be mainly question and answer going forward. It's going to be question and answer. Then what we will do is we will use that question and answer to solve the questions, to remind you of the, what is it called? Concept. So somebody shared a screenshot. It said, he shared a screenshot on a question that an analyst gathered the following information. Your ROE is 15%. Your interest burden is 0.85. Your EBIT is 30%. Your asset turnover is 1.1, and your financial leverage is 1.25. The average tax rate is closest to what? See, what they're asking you for is this number 1. Is this 5 and the first one. So plot this 15% here. This is the missing figure. So do your interest burden 0.85, multiply by your 30%, multiply by 1.1, multiply by 1.25. Whatever you have, make this the subject of the formula. Multiply by ROE, then you get your answer straight. That's it. So if I can do this, if I can just do this now, if you do 0.85, multiply by 0.3, multiply by 1.1, multiply by 1.25. So you are having, what do you have there? Yeah, that's your answer. So if you multiply 0.85, multiply by 30%, multiply by 1.1, multiply by 1.25, right? Then you will have about 35 or 36%. Make it subject of the formula. So meaning your tax rate equals 15% times that, you get 57%. That's it, really. They just want you to make this the subject of your formula, and that's it. So somebody's saying that share-based payment. So share-based payment is mainly when companies are paid instead of cash, they are paid like using shares, like options, share options. So it means that they will be, so it is part of this when we are talking about financial adjustment, right? Financial analysis quality. It is because I abbreviated it. Their compensation, when it's based on so profitability, they will say, oh, if the share price should move from probably 20 to 30, you will get 10%. Some people are giving shares at a price. Let's assume I'm giving shares at $10, and the company share price is presently at 8, right? So meaning that I want that shares, I want to be able to exercise that option. And I'll be able to only exercise it if the share price is more than 10. So it is a part of motivation for me to ensure that the share price move. And what can make the share price to move? When you report a good profitability or good financials, then law of demand and supply can play in, then the share price can go, then I can be able to have some gains, right? So that means that it can affect the motivation of the but I don't expect any calculation for share-based payment for you at level 1. Share-based payment is a topic on its own. Share-based payment, that is employee compensation, pensions. It's a huge topic in level 2. So just know that this is part of what can make can affect the reporting quality, right? Yeah, I can say when is the next month, when is the next bootcamp, sir? Well, it will be communicated. So now say the tax body is your average tax rate. People have but make it your subject of the formula. All right, guys, that's that. In the absence of any other question, I think we are done. Yeah. Gloria, am I free to leave? I think the next guy should be on ground now, right?
No, you actually had up to 4 p.m. Let me quickly confirm if the next person
4
is
p.m.
available.
Wow, I thought it's even 3:30. I thought I've taken all the time, man.
No, it was
when you're talking.
hours, minutes. Yeah.
That's good. That's good. That's very good. All
You
right,
can
guys.
actually
So,
talk for more questions. Yeah.
all right. So let me just use 5 minutes or 7 minutes just to give you guys some stuff, right? Look at this. What I would advise is this. Take as much questions as you can lay your hands on. Solve them. At this point, the questions will teach you on some of the concepts that you have forgotten or probably you have missed, right? So please, solve as many questions as you can. If you have a reading partner, talk to the reading partner. I would have said, talk to me if you have any question in any area, but now my hands are tied. It might take some time for me to respond, right? It might take a day or two because I'm moving countries. So I would have loved that. I would have, because in any areas of your syllabus, any of the topic areas, I can take you guys on it, right? But what I would advise is solve as many questions as you can. Understand the reasons for those answers. The reasons are not far-fetched. They are usually in those questions, most likely, least likely. They just coin it, right? Closest to. It is not a negative marking. That means that you must solve as many questions as you can. The ones that you don't know at all, that you cannot solve, that you don't know, go back and put answers there. You might get them. It's a 50-50, right? You might get it or not. So if you still put the answers there, you have given yourself a 50% chance of getting that stuff. But if you don't put at all, you have a 0 chance of even getting it, right? So even people that are on Discord, you guys can actually form a WhatsApp group. I think it's one of the things that we can actually do in the society. I think it was done in the past, where we have like a group of people that are registered, that are actually doing that exams, right? Then you guys can communicate, understand. Then if you need any stuff, some of the facilitator or some of the members are knowledgeable can come into that group, explain to you, and go out, right? So I think it's what has been done in the past, probably to be revisited, So that is why you should stay glued to the society. Make sure that your email address, your numbers, your these things are with the society, right? So guys, so in essence, give yourself a chance of passing. Don't leave any question unanswered. Make sure you put an answer there, even if you don't know it. But make sure that you have answered all the ones that you know correctly. Then go back and put answers there. At least you are giving yourself a chance of getting that mark. But if you leave it open, it means that it's zero, right? So most of the times, students might understand all the concepts, they get all these things, but they might not have that exam technique, question answering technique. And the only way you can get that, no one can teach you. Yeah, you might be taught when you are doing some question and answers, but you have to discover it yourself, actually, by solving as many questions as you can. I think there's this software and all those things that you can buy question and answer. Try as much as possible. Try as much as possible as you can. Solve as many questions as you can, right? That would be my advice. Yes, like I said, there might be a group chat. I'll talk to the society. I think something was done like that in the past, right? So I don't know yet. So you guys can have that, right? Yeah. So Yemi is answering, right? That this is the CFA society has a forum on the website that can host a discussion where facilitators like Shegun can. Yeah. So that is what I'm saying. So go there, register. Don't do it on your own and say you want to. Sometimes iron sharpened iron, right? You want somebody to help you. But if you are writing this August, solve as many questions and don't fast. Don't fast on the exam day. Don't fast. Fast before the exam and fast after the exam. But don't fast on the exam because your brain needs all the sugar, fats, everything to be able to work at optimal level on that day. You think by fasting, you are praying to God to be able to pass, except you have a strong energy. This exam, it will take all the energy you think you have in your life. It will take, that 6 hours is an energy zapping hours. It will take it off. So you need all the sugar, all the tea, all the bread, eat it. Use the energy, then so you can fast before the exam day. Don't fast on the exam. You will collapse. And if you don't, right, you might get agitated or apprehensive and your brain might not work optimally. You might be reading average as stats. You might be reading most likely as least likely, so, and don't take too much toilet breaks, please, yeah? Take water how you can. If you think you want to do, just take some break, take your, forget prayer and fasting on that day. Pray before that day. I think the Bible even says here something about you praying before the event occur, right? So pray before that day. Don't fast on that day. Even if you are used to fast, that are semi, this is an energy prayer. So in fact, you need to take strong coffee. When I was writing my exams, I normally take enough sugar. On that day, I'll take enough sugar. Even my level 3, I took energy drink like 2 in the morning because you need that energy. At the end of the day, when you finish the exam, you will be spent. You will be spent, as in you will be spent. So please, guys, you need to. So I wish you success. I pray for your success because your success is the society's success, right? Because as you guys pass, it reflects on us as a society and as a country, right? So please, I wish you well. And if you need any help, if you need anything, try as much as possible to contact the society. The society library, I'm sure, is opened, is there. And I wish you all the best. Thank you so much, guys, and have a good evening. Gloria, Yemi, I'm out. Thank you so much, guys. Bye.
Thank you so much, Shegun. Bukola is actually available for portfolio management. So yeah, she's going to take over now. Hi, Bukola. I've
Fantastic.
just made you co-host.
Bye-bye, guys. Buki, take
Thank
care.
you.
Hi, Shegun. Hi, Gloria. Hi, everyone.
Hi, Bukola. Welcome.
Hi, Buki. Welcome.
Hi, thank you. And I truly really like that Shegun's last parting words. You need all the energy. So please, for the geos in our midst, fast and pray before the day, so that you don't expend all your energy. All right, let me try to share my slides. Okay. I'm going to take a slightly different approach from Shegun, if you guys don't mind, because I believe that majority of us in here already are writing the August diet. So I'm going to just have, what I normally do is I do like a summary overview of what you're expected to know in that particular topic, and then we do some questions. But if I may ask before we start, is there any topic exactly that you would like us to focus on, so that we'll be able to take out something very significant out of this meeting, or just go through the general overview of what portfolio management? Why am I not surprised when I'm seeing risk and return? That seems to be everyone's. Somebody said general overview, somebody said risk and return. All right, we're going to try to do a general overview, but let's start from okay, general overview then. General overview carries the bold. Try and focus more time on the risk and return part, because I know a lot of people have issues with all those graphs and all those equations and all. So basically, let's quickly run through. I'm trying to chart and okay, risk and return, please. All right. Okay. What do we do? Let's just do an overview. We'll do everything. Let's just pick like 3 topics. We'll start with let's do the overview, and then we'll go. So portfolio management, as we know, sorry, my slide might not be changing. It's not because it's not changing, just because I really don't have anything. I'm just, hard working everything I'm saying off the head. So you're supposed to be able to describe the portfolio approach to investing. Now, portfolio approach to investing simply means that we're discouraging the fact of you having a silo investment by having just one asset, or having different assets in the same industry in your portfolio. If you have the same assets or the same industries in your investment, you can't call it a portfolio. It's still a silo. For instance, if we have 2 investors, investor A and both investors have 100,000 naira to invest. If investor A invests all his 100,000 naira in, let's say, GT Bank, and investor B shares his own 100,000 amongst GT, Zenith, Access, UBA, both of them still have one investment, because whatever happens to one bank happens to all. So we are saying that for you to have a portfolio approach to investing, you need to diversify your risk. And the only way you can diversify your risk is to be able to pick assets that have low correlation with one another. That is when you can say that you have a portfolio. So let's say we have an investor C, who now have his own 100,000, bought some GT, bought some Nestle, bought some mobile, bought some which other industry do we have there? Bought some insurance. Now, in different sectors that have low correlation with one another, they can say that investor C has a portfolio. So the major reason why we do that is for you to be able to diversify your risk. Now, what are the steps in portfolio management process? You have 3 approaches. You have 3 steps to portfolio approach, you have the planning stage, you have the execution stage, and you have the feedback stage. Under the planning stage is where you get to understand the needs of your clients. And that's the very first step to the portfolio investment process. After you understand the need of your clients, you know their constraints, you know what their return and risk objectives are, then you can now go on to the execution stage. In that stage, you try to look for assets that are going to help you to be able to achieve the objective of your clients. In under the planning stage, determine what asset allocation is going to be, what percentage you're going to have. If you're going to have, let's say, 60-40 investment, 60% in fixed income and 40% in equity, because the investor in question is risk adverse, then you now go further down to look at the quantum of fixed income investment that you have to pick the best that would meet the objective of your clients. And then also you go into the stock exchange to analyze the stocks available to be able to pick the ones that have low correlation with one another. And then you execute, which means you buy the shares. Under this part, you know what we call the strategic asset allocation, which is that allocation that you think it is proper for your investor to have. Like we said, 60-40. But there are some times where the market would be in this equilibrium, which means that you might feel that you have a better chance to make more in equities than fixed. You can decide to tweak your allocation from 60-40 to say 70-30 or 80-20, just for the short run to be able to make the best of what you have, and then you go back to your 60-40. That is what we call the tactical asset allocation. You move from your strategic to tactical and go back to your strategic. And then lastly, you have the feedback stage, in which you now go check the portfolio that I have constituted. Am I been able to meet the objective of my clients? If yes, how? If no, what happened? Because you have to know all the positive and negative variances. Not only positive, you clap for yourself. No. And then under execution, you have what we call your monitoring and rebalancing, because you have to keep monitoring your portfolio and rebalance back to 60-40 whenever you deviate from that. And then we have the third thing you need to know is to know the different type of investors that we have and their distinctive characteristics and needs of each of them. Now, we have two major broad classifications of investors. We have the private investors and we have the institutional investors. Private investors means individual investors. Now, we cannot categorize everybody as one because we all have different needs, we have different wants. So we cannot have a one-size-fits-all kind of portfolio for such individuals. But under institutional investors, we're able to break it down to places that have similar characteristics. We have the banks, we have the insurance companies, we have the sovereign wealth funds, we have the endowments, and we have the foundations. And then we have what we also call the defined benefit pension plan. Now, you should also know the difference between the defined benefit pension and the defined contribution. Defined benefit pension plan is because under that plan, you already know what your benefits are. The risk and return of that portfolio, of that investment, lies solely with your employer. That is why we have them as a distinct investment type, because the risk and return lies with your investor. For such kind of pension plan, when you enter into the organization, you already know that if I work for 5 years, 10 years, 15, 20 years, as the case may be, this is what my benefits accruable to me are. How those benefits are made is dependent on the investor or your employer. Now we have what we call the defined contribution, which is what is happening in Nigeria at the moment. That is not an institutional investor. That is also classified as individual, because in this case, all you know is how much you are contributing into the plan. The risk and return of that plan lies solely with you, the investor. So it is also classified as an individual investment. So if you look at the characteristics of the institutional investors, for banks, you know that the banks are liability generating banks. The money they have does not belong to them. So they have high liquidity, short time horizon, and then they have to ensure that they place the funds in near liquid investment so as to ensure there's no default of credit risk. Also similar to insurance company, but insurance companies are now divided into two. We have the life insurance companies and we have the non-life. The life insurance company have a longer time horizon than the non-life because you have the number of years that is based on your actuarial tables, number of years you're expected to live and all. But for the non-life, you can have an insurance taken on your car in the morning, and by afternoon or 10 minutes after you take, you make a claim. The insurance company cannot say that you just insured. They have to make you good. So for non-life insurance and the property and casualty, they also have a shorter time horizon compared to the life insurance, and they also have to be liquid. Then I just explained that I'm not changing my slides because I don't have what I'm saying written down. I'm looking at what you need to know, and I'm trying to expose more on what you need to know. So my slide might not be changing as frequently as you expect it to. It will change more when we start delving into questions. So yes, we will solve questions, Aditola. We will solve questions, yes. So I've talked about defined contribution and defined benefits. Then different types of aspects of asset management industry. You have the buy side and the sell side. And then talk about the big data right now, your investment processes and the robo-advisors that you use to help in the wealth management industry. So I'll leave that. And then let's talk about the mutual funds, which is something that I really like to talk about to candidates. Now, for mutual funds, we have two types of mutual funds. We have the open-ended mutual funds and we have the closed-ended mutual funds. For the open-ended mutual funds, you can invest at any time. You can liquidate at any time, but you have to wait at the end of day to be able to trade at the net asset value. And net asset value is the assets of the fund minus all its liabilities divided by the number of shares outstanding. So when you have an open-ended mutual fund, it allows you to be able to buy and sell as the fund manager. It also has its own advantages and disadvantages. Now, sometimes when it's open-ended, you can have so much people buying into the funds when you don't have any investment to invest the money on. So you have idle cash with you. And also you can have people coming to liquidate when you have so much potentials for your investments. You have no choice but liquidate prior to time. But remember that your open-ended mutual funds, the number of shares outstanding changes at end of day every day, but it trades at its NAV. So even if you want to invest or liquidate during the day, you wait at the end of the day to know how many shares you are getting or how much you are getting in return. While the closed-ended mutual fund is closed, meaning the manager sets up the funds, sell its shares, and closes the funds. So whoever wants to invest or divest from the fund now do that on the secondary market. So the number of shares outstanding on a closed-ended mutual fund remains the same at every point in time. This sometimes can stifle growth because there might be times that you have investments that you could invest in, but you don't have cash to invest in. Okay, but at least it ensures that you don't have idle cash with you. So that can be traded at any time during the day. Remember, it's traded on the secondary market. So you don't trade at NAV, you trade at any time the price is at whatever it is that you want to get into the market. And then for other pooled investments, we have the exchange traded funds, which is a mix between the open-ended and the closed-ended. You have the sovereign wealth funds, and then you have the separately managed funds. All right, so that's basically the overview of what we need to know in the first. So let's just quickly go into some questions. They also have the private, I talk about the hedge funds, which you know, like we call it the black market of investment. You need huge funds to be able to invest in this kind of funds, and they have little or no regulation, okay? And then unlike mutual funds that you need to register with the SEC, have a prospectus, because we have lower funds going in and you have so much more people that are investing in that. Private equity are those funds that invest in companies that are not listed on the stock exchange. So they are privately owned, while venture capitals are those funds that invest in new ventures, okay? The difference between venture capital and private equity is that private equity invests in already established businesses, even though they're not listed on the stock exchange, while the venture capital invests in startups, Okay. That's basically the two difference between the private equity and the venture capital. So let's just look at some 2 or 3 questions before we go on to the next one. So number 1. Okay, thank you, Joy. That's why it's A. Yes, Diva. A, Joy, yes. 2 joys. Oh no, Samson. The answer is not C. The answer is A. What portfolio does for you is just to allow you to diversify your risk. It does not mean that you still cannot lose. You can still have loss, but the loss you're going to incur in the portfolio will be lower than that of what you would have incurred if you have just one asset that you invested in. So the answer is A. Okay. Definitely, when you have a portfolio, you will not have a concentration in one security. So B and C are one of the benefits of portfolio, but A is the answer to this question. Thank you, everyone. Okay. The opportunity to achieve a return in excess of the market return. Yes, you can achieve more because the market is not always in equilibrium. So you can always look for when the market is in this equilibrium and then invest appropriately to have a return in excess. That's why you have what we call the Jensen's alpha. Yeah, for number 2, yes, number 2 is C. You have a short-term horizon because the bank, the demand deposits, people are coming to the bank anytime to request for their money. So you have to be ready to pay them. So you have a short-term horizon and you have high liquidity needs as a bank. So the answer is C. Thank you. Yeah, thank you. It's an open-ended mutual fund that will also change quite frequently at the end of every trading day. Yeah. So number 4. Yes, number 4. Hedge fund require a much larger minimum investment than a mutual fund, and it has less stringent reporting, and it is not liquid because it's not traded throughout the day. B and C are characteristics of a mutual fund, while A is characteristic of a hedge fund. So the answer is A. So quickly we go to the next topic, which is basics of portfolio planning and construction. This is where you have your IPS, which is the investment policy statement. Remember, we said that before, under your planning stage, this is what happens under the planning stage. You try to understand your clients, so you draw what we call the IPS. Under the IPS, you should be able to describe major components. You have your risk objectives, your return objectives. Talk about your constraints. That is, what would not, what will what's English or not enable your clients to be able to achieve what he wants. So we have 5 constraints. We have liquidity needs, we have tax considerations, we have time horizon, we have legal and regulatory factors, and then we have the unique factors. Liquidity, talking about how frequently or at what point in time would you need to withdraw from your investment. That is what liquidity needs talking about. So the longer time you have to invest, or the lower the time you need, the lower the frequency of time you need to withdraw from your portfolio, the more risk that portfolio can take, because you have a longer time to be able to recoup in case there is a loss. So liquidity has to do with time horizon, right? Because liquidity is talking about how frequently do you need money, And that means how often, which is time horizon. So the lower liquidity need you have and the longer your time horizon, the more risk you can tolerate. Tax consideration talks about which kind of tax are you faced with? Talking about your capital gains tax or talking about your withholding tax? Which one is higher? So if your manager tried to control that portfolio in such a way as to ensure that the gains on that portfolio is met with the least amount of tax payable. Legal and regulatory talks about government, legal, what do you need to have in place, what you need to do. So not necessarily have to be with what your client needs, but it's more about what the government requires, the regulatory requires. The unique circumstances dependent on your investor. What are his preferences? Some, due to religion, would not invest in some certain kind of investments. For instance, prostitution, gambling, hotels. And some, maybe to personal belief, would not want to invest in some particular kind of companies. So you need to know. Now, your IPS is supposed to be reviewed regularly, maybe once in 3 years. But how often it will be, it would be reviewed, will be agreed on at the initial point. And also, you also have to review the IPS immediately after there's a change in the position of your client. So you will not say, oh, the next review is the next 3 years. So for instance, you have an oil company worker, an engineer that needs his 2 hands to be able to work, and he has quite a huge fund for you to invest in. And because he's still young, he's 26 years old, he believes that the liquidity needs from his investment is very low because salary is enough to take care of him. So because he's 26 and he's thinking he's going to retire at 65, he has like about 39 years more to work. So he has a long time horizon. For his tax, he believes that, you know what, both capital gains and my withholding is the same, so it doesn't really matter where you put it. I'm faced with the same tax rate and doesn't have any unique circumstances. And then you drop the IPS, and you but agree that, oh, this thing will be reviewed in 3 months, in 3 years' time. So in 6 months after that, he got into an accident and he loses the use of his hand, which is the major tool he uses at work. So you're not going to say that, oh, I just reviewed 6 months ago, so wait for another 2.5 years. You have to review that immediately because circumstances have changed. He might need to now withdraw more from his portfolio because it cannot work anymore. So you need to put that also into consideration. Okay. So we'll talk about how ESG is integrated into your portfolio construction. All right. So we're going to talk about, before we go in there, let's talk about your client's overall risk tolerance, talking about their ability and their willingness to take risk. Their ability is based on quantitative matters because sometimes it can look so similar, so you need to know its ability is based on quantitative matters, which means how much does it have to invest, how much return is it looking for, something quantitative that you can see. While your willingness, talk about your qualitativeness, might be about your disposition to risk. It doesn't have to do with what you have, but about what you think you need. Now, for you to have a proper portfolio, both your willingness and ability must be on the same score. But sometimes you find situations where ability and willingness are different. So when they'll always say that ability carries the day at any point in time. So you have to educate your investor that he can be able to take more risk from what you are seeing and educate him to be able to up his willingness. Sometimes people don't even know what their willingness is. So you need to educate them, give them open-ended questions to be able to gauge and guard what their willingness is. But if willingness supersedes ability, like I said, ability takes the cake. Okay? So we'll talk about ESG in investing. There are different ways in which ESG has been integrated into the portfolio construction process. The first one is negative screening. Negative screening is talking about you exclude those investments that you feel do not have the required ESG that you require. The positive screening means including everyone that has positive ESG integrated into their work. Then ESG thematic investing means that you're investing for a particular in companies that have a particular that focus in particular ESG. For instance, you can say, I want to invest in companies that are actually against pollution. Then when you have thematic investing, you're investing both for profit and also for a particular ESG. Okay. Then you have engagements and active ownership. The allow you to be able to use shareholders to be able to have a change in companies that don't have good ESG integration. All right. So that's about that. So let's go. Number 5. Developing your asset allocation happens in the execution stage. The answer is C. Planning is where you get to know your clients. That's what you're doing in planning. Get to know your clients. After knowing your clients, you now want to execute. That is when you now decide what the allocation should be, which assets should be there, and all that. So the answer is C, execution and not planning. Number 6. Yes, thank you. Under execution, you determine the assets class ratings, you analyze securities, but under feedback is where you assess the performance of the portfolio relative to that of the benchmark. All right. So what is the job of a good IPS? Sorry. The good IPS would communicate both the objectives and the constraints of the investor. The whole idea of the IPS is for you to have a plan to be able to accomplish the portfolio success. So the answer is C and not A. A and B are included in the IPS so as to have a successful portfolio. So the IPS is actually intended to communicate your plan to accomplish a portfolio success. Yes, Oluwato to see me. Wow. The answer is C. Yeah. The number 8. The primary decision that arises out of your IPS, I'm seeing A, I'm seeing B, is your benchmark selection. The answer is C. Joy. Yes. Yes. It's a primary decision that arises out of your IPS. It's benchmark selection because after you have done the asset allocation, you have done security selection, you need to know what you are matching your performance against. So a primary decision that arises from your IPS is benchmark selection. So you need, because so that you will not have a portfolio of securities of securities and then start matching it with a benchmark of fixed income. So that's it is about, it's not about picking the odd one after. No, it is not about picking the odd one. That is not a secondary consideration, Adetola, because you can have a portfolio on its own without you measuring it against something. You have to be measured against something. And where does that come from? You have to agree at the beginning of your IPS what okay, let me break it down because I didn't say that. Under the objective of your client, under the IPS, you have the return objective and the risk objective, right? Both of them can either be relative or be absolute. Relative means that you are trying to compare your performance against something. If one is absolute, you still want to know whether you are meeting or not. So one of the differentiating characteristics of your IPS is your benchmark selection, talking about which is what comes up during the planning, talking about the objective of your client. Okay, so we're already done 25 minutes, so we have 5 more minutes. I'm not going to really spend so much time on behavioral finance, but you're able to know that it is divided into two: cognitive and emotional. Cognitive is also quantitative. It has to do with maybe mistakes in calculation. It has to be something that is objective to be a cognitive error. While your emotional biases emanates from subjective, how you feel. What do you feel about this? So your cognitive can be just come from maybe a mistake in the inputs that you have. Maybe you have faulty information processing, or you have memory errors, you could not recall something properly, or faulty reasoning. That is cognitive, something that is substantial. Why emotional is based on how you feel, is not rational. Okay, maybe your loved ones bequeathed you maybe some stock of shares, and the stock is going up, you should sell. Because of the sentimental value you attach to it, you refuse to sell. That's emotional. It's based on your feeling. It has nothing to do with your reality. So you need to know which ones are cognitive, which ones are emotional. Sometimes the two of them have ones that are similar to one another. So don't confuse yourself. So you need to be able to know the difference. I'm trying to go to risk and return, which is what most of people ask us to actually delve in. So that's what I'm going to talk about under behavioral. So quickly, let's just quickly look at this. 2 questions or 3 questions I have on the rate or so. So let's go. Yes, thank you. Confirmation bias. Yes, it is similar to endowment and regret aversion, because it also means you're trying to retain what you have, and most times you retain because you do not want to regret taking a decision, but it doesn't have anything to do with confirmation. So the answer is C. Yes. Number 10. Endowment bias is talking about when you value an asset more because you have it now than when you do not. For instance, if you buy something, let's say you just bought a car, and you bought the car for like 10 million naira. Somebody comes to tell you, oh, let me pay you 10 million. You say no. I want 12 million, because right now you own it. You feel that it has much more value than what it is. That is endowment bias. So number 10 is A, availability. Availability means you able to recall something that just happened, of recent. So because John works in a hedge fund and a lot of them are charter holders, he's able to recall, is available information to him that a lot of charter holders work in hedge funds. So it is normal for him to think that most charter holders work with hedge funds. So the answer is A, availability. So let's go to I will focus on risk, because it's risk. Conservative is when you're kind of reluctant, you're conservative in what you're doing. That's what conservative talks about. It's not about recall. So I'm going to leave risk totally, so we can quickly go into, so we have 30 more minutes, so we can do portfolio risk and return part 1 and 2, and then we call it a day. All right. So they say it's also describe characteristics of the major asset classes that investors consider in forming portfolios. We already talked about assets, talking about stocks and equity. That's major characteristics which you should know. Equities will talk more of equities, other equities, and fixed income will talk more on fixed income. So I'm going to leave that. So let's talk about risk aversion, implication, mean variance, interpretation deviation, and all, and so on and so forth. First thing I want you to know that risk and return sometimes might not actually be totally asked in mathematical form, and also ask you these questions in English form. So you need to actually understand, you know, what it is. So the first thing you talk about is the holding period return. And holding period is just talking about what you earn when you hold on, when you buy an asset and hold on to it to maturity. That's what holding period means. So holding period can be 2 years, can be 5 years, can be 1 month, can be 3 months, as the case may be. That's the holding period. And then you can also aggregate multi-periods for you to be able to know what the holding period is. Okay, your holding period return, like we know, is usually the capital appreciation, the PT minus PT minus 1, that's capital appreciation, plus any dividend you earned during the period divided by your PT minus 1. So your holding period return is a combination of your capital appreciation and your dividend yield. So we have multi-periods and you're asking you for the holding period return, just look for a compounding. That'll be 1 plus R into 1 plus R into 1 plus R minus 1. R being the return that you have for each period. Okay? Now, risk-adverse investors make decisions based on the risk-return trade-off. So the graph that talks about the risk-return trade-off of an investor is called the indifference curve. Your indifference curve is a curve that graphically represents the risk and return trade-off. And because our risk and return, our risk adverse is different, so indifference curve are unique to individuals. It's not the same for everyone. It is unique to individuals. Now you have 3 types of risk tolerant people. We have the risk adverse people, that people that don't want risk at all. So they need compensation for every unit of risk that they take on. That means that the slope, the indifference curve will always be upward sloping. And you can also have risk adverse investors at different levels. We are all rationally risk adverse, but we still take up more risk than the other. So the more risk you take, the steeper your indifference curve is going to be, and it's going to be upward sloping. The other type of risk adverse investor that you have, another risk tolerance investor you have, is the risk neutral people. As a risk neutral person, you're not really bothered about the risk that is the portfolio is facing. You are more interested in the return. So you ignore the risk components of it. So your indifference curve for such a person will just be what? Horizontal to the return. It doesn't go with the risk. While a risk seeker has a downward sloping curve because it's looking at his own investments from the angle of risk. So he will go for that investment that gives him the highest risk. Okay. Now for level 1, we're talking about the risk or the portfolio of we are talking about a 2-asset portfolio. It could be equity, 2 equity, it could be equity and fixed income, as the case may be. So I remember when we talked about portfolio, we said you should look for assets that have a low correlation with one another. So correlation talks about how the assets move in relation to one another. When they move in the same direction, they are said to have a positive correlation. When they move in negative direction, they have a negative correlation. And when the movement of one has nothing to do with the movement of the other, they say they have no correlation. So for you to actually have a portfolio, you look for assets that have a negative correlation with one another. They can say you have a fully diversified portfolio. But in reality, that does not really happen. So say we look for assets that have a low correlation with one another. So for you to be able to get the variance, the risk of a portfolio is measured by its standard deviation. And standard deviation squared is equal to the variance. So the variance of a 2-asset portfolio will be equal to the weight squared of asset 1, variance of asset 1, plus the weight squared of asset 2, variance of asset 2, plus 2 plus 2, weight of 1, weight of 2, standard deviation of 1, standard deviation of 2, correlation of 1 and 2. And you know that your covariance is also equal to standard deviation of 1, standard deviation of 2, correlation of 1 and 2. So sometimes the question will give you a covariance. What they've done is they give you the last 3. You just multiply the covariance by the weight of each of the assets times 2, and then you go on. So don't start trying to see, oh, what's the correlation? Because you're just wasting time. And also, try to notice what the question is giving to you. So question will give you the variance of each of the assets. Don't make a mistake under exam pressure to go square it again. Then I don't know what you're getting. I'm not a mathematician, but I'm sure that your answer will be waiting for you, your ABC. But don't bother to say to start looking for standard deviation before you use it. Just take it the way it is and put it in the formula. And if you have standard deviation, remember to square it, because if you forget to square it, your answer will still be waiting for you. Now, for you not to have any issues at the end of the day, I'm always saying that you should try to leave one of the variables in actual number and use one of the variables in decimal. I normally put my weights in decimal and my standard deviation in absolute numbers. So which means that the final answer I get is what I need. But by the time you send both of them to decimal, you have to start multiplying them by 10,000 to get your answer. And during exam conditions, sometimes you might actually just make an error. So try to leave one in decimal and one in actual number so I can have your final answer. Okay, can I recap variance and standard deviation squared? Okay, fine. If you have gone through your end of chapter question, you will read some code that will say that the variance of asset A is this, the variance of asset Y is this. Just pick that variance, because what you need in your formula is the variance. So I think I made a mistake somewhere. This is the standard deviation. Once introduce the square root, I'm talking about standard deviation. So this is the variance. That is what you require. So if the question is telling you the variance of asset X is 20%, don't make a mistake in your rush and remember that, oh, this thing needs to be squared, and now come and say 20 squared again. You'll be wrong. And you find your answer in ABC. So always be sure of what they are giving you, or maybe they give you covariance and then you make a mistake in the you're under pressure, go and use your covariance and use it as your correlation, forgetting the fact that your covariance is your standard deviation of two assets multiplied by its correlation. If you put that also, you still find your answer. So you have to be very, very careful when you use this formula. Okay, so let's look at how the focus of this is for you to be able to build an optimal portfolio. So when you have the indifference curve, let's look at the indifference curve of a risk adverse person who said is upward sloping. Right? Then you bring in, okay, before we do that, let's say, before we go to that, we bring in what we call the efficient frontier. The most efficient frontier, on that frontier lies assets that are efficient. An asset is said to be efficient if there is no other assets that have a lower risk for the same level of return, or a higher return for the same level of risk. Yes, you find your answer. That's the thing. Any slight mistake you make, you find your answer, and then you think you have nailed them. You are nailing yourself. So you have to be very careful. All right, the efficient frontier on that it was built by the scientist called Markowitz. Among the efficient frontier, on that line lies efficient assets. And an asset is said to be efficient if there is no other asset that will give you a higher return for that same level of risk, or a lower risk for that same level of return. Now it starts from your global variance, your global minimum variance portfolio to the right. And then you now introduce a line that starts from the risk-free rates and lies tangent to the efficient frontier. Sorry about I don't know how to draw. Okay, but just listen to me. Leave my diagram alone. So this line that you introduce to the efficient frontier is called your capital allocation line, your CAL line. On your CAL line lies only efficient assets. So using the linear equation of y is equal to ax, your intercept of your CAL line is your risk-free rate, while the slope is your Sharpe ratio. The intercept is a risk-free rate, while your slope is a Sharpe ratio. Then you now introduce your inference curve. However, your inference curve lies tangent the CAL line is the optimal risky asset that you have to invest in. Okay, so let's go on. So some questions. Number 14. Yes, like I said when we started, when you pick assets in the same sector, they are highly correlated with one another. So within asset class will be higher than among asset class. So the answer is C. Thank you. Thank you. Remember the utility formula is equal to the return minus half your correct coefficient, then variance squared. Now, why this would be A for each one? Because remember they said risk-free. A risk-free asset is an asset. No. The answer is A, blessing. A risk-free asset is an asset that has zero standard deviation. And we all know that anything multiplied by zero will give you zero. So which means under these circumstances, this all becomes zero. So the utility of everyone will be equal to the return of the portfolio, which will be the same for all individuals. So the answer is A. Thank you. Number 16. Yes, your optimal risky your optimal asset I just explained is that lies tangent to your efficient frontier. Remember, the CAL line is introduced to the efficient frontier. So that would be your optimal. Your portfolio is not who wants to invest in a fully diversified portfolio. No. Sometimes you have what we call the non-thematic risk. Okay. So the answer is B. Your optimal portfolio lies tangent to your efficient frontier of risky assets. The answer is B. Which of these is least accurate? The impact of leverage would not give you an optimal portfolio, but the impact of leverage will just allow you to be able to make a return higher than that of the market. Remember, you have two portfolios. You have a lending portfolio and a borrowing portfolio. A lending portfolio is the one in which you have positive investments in your fixed income or your risk-free rate, while the borrowing portfolio is where you have a negative return. The only reason why you have borrowing portfolio is you feel that you can make much more than what the market is giving to you. Does not make your portfolio to be optimal. So the one that is least accurate in this is saying that your slope decreases as more risk is taken. No, your slope increases as more risk is taken. So the least accurate is A. Yes, so let's look at for a graph. Let's try this graphically. So we have different risk adverseness. This person, A, has taken on more risk than C. So a less risk adverse person would have a flatter indifference curve that all upward sloping, but the slope would increase as more risk is taken. So the answer is A. So I see some people say took A, some people took B, some people take C, but the answer is A. Your slope increases as more risk is taken, not decreases. Number 18. You can see what I'm trying to figure out for you here now is that you can actually answer questions on risk and return without having to calculate. Yes, Rotimi, the question says lists. For Shunat Prasha, I'm sure that the society, Gloria, correct me if I'm mistaken, those slides will be shared to all participants, correct?
Yes, please.
All right, so everybody's going to have the slides. Thank you. So number 18, which of this portfolio should he invest in to reach his objective, or is best for him to reach his objective? Thank you. Remember, we said that for you to have a perfectly diversified portfolio, you should take assets that have a negative correlation with one another. Is when there is none available that you pick the one that has a very low positive correlation. Because GTY already has a low correlation, it's best for him to put that in his portfolio than XYZ. So the answer is C. All right. So let's do one equation. Let's do one question calculation. The following decision to divest is non-core assets. Analysts expect HCL Corp's standard deviation of return to rise to 30%, and its correlation with the market portfolio to remain unchanged at 0.8. The risk-free rate and the market risk premium are expected to remain unchanged at 6% and 8% respectively. The market portfolio standard deviation of returns, however, is expected to decrease to 15%. So what is going to be the firm's expected return after the restructure? Okay. Somebody is telling me the answer is B. Somebody said it's C. The answer is C, actually. So let's try to get what they're asking for. They're asking for the firm's return. So we're trying to use what we call the CAPM formula, which you know that the return of the portfolio is equal to RF plus beta into RM minus RF. Now the question gave us RF. The question gave us the market risk premium, but it did not give us the beta. So we need to get the beta. Remember, the beta is equal to the covariance of the asset with the market divided by variance of the market. And the covariance, like we just said, standard deviation of each of the assets multiplied by their correlation. So this goes with this. So you have standard deviation of the asset, the correlation, and that of the market. So let's fill in the gap. Standard deviation of the asset is now 30%, 0.3. The correlation remains unchanged at 0.8. And the standard deviation of the market is 0.15. So what do we have as our beta? That is 0.24 divided by 0.15. That should give us 1 point what? 24 minus 15 should give us 9, I think. 90. That'd be 1.16. So to put this into the formula, so the return will now be equal to 6% plus 1.6 times 8%. That will give us what? 6 plus 12.8, which is 18.8%, making 19 to be C. Okay. Okay, number 20. Oh, we have just 8 more minutes. So let me quickly talk about return and return part 2. Now, the CAL, like we said, is unique to individuals because it has to do with that indifference curve. Now, due to some assumptions, like people have homogeneous way of thinking, which is very important. We are price takers, we have a single time horizon and all that. It now become that because we have a homogeneous way of thinking, we all pick the same asset as the optimal asset. So that asset is called the market portfolio. So that graph is now called the CML line, which is a capital market line. Capital market line and the CL line are the same at the same time different. The same being in the sense that the slope and the intercept of both of them remains the same, but the CAL is unique to individuals, while outside, I don't know why it's still taking B. The answer, oh, for the last question. All right, I didn't even check the answer. All right. So the CAL line is unique to individuals. Let me see the question so I can answer you appropriately. What number is that? Number 20. Yes, the answer is B. So you're right. The answer is B. Yes, the answer is B. So the CML is the same for everyone, while the CAL is unique to individuals. Okay. Then we also have the CAPM, which is a graph. We also have the security market line, which is a graph of the CAPM. Now, on the CAPM, on the SML line, we are talking about rightly priced assets and not efficient assets. And the risk we use in this one is beta, while the risk element in the CAL and the CML is what? The beta. Now, when you have the assets, you have is also a straight line from RF going upwards. Now, when you have assets on top, we are saying the assets that are rightly priced will be on the SML line, on this line. So any asset that has a return above that line are said to be undervalued, while any assets that lies below are said to be what? Overvalued. And remember, when you want to add to your portfolio, we say invest in undervalued assets and sell off overvalued assets. So your SML line talks about rightly priced, not efficient, because it is beta that they use as the measure of risk as against standard deviation. So this is talking about a fully diversified asset, because the market will only compensate you for systematic risk, which is measured by the beta, while the CL and CML has both systematic and unsystematic, which is measured by the standard deviation. Okay. Then you should also know that you don't have risks together. For you to get your risk, you have to find the variance, sum the variance, and then find the square root to get your total risk. Then for you to be able to interpret, we have the M squared, we have the trainer, we have the Sharpe ratio, and the Jensen's alpha. The trainer and the Sharpe ratio are relative measures because you need to compare them to something. The Sharpe ratio, like we said, is the slope of your CL and your CML, while the trainer is similar, but it now uses beta as its measure of risk and non-standard deviation. What Jensen's alpha is the difference between the return of your portfolio and that of what the CAPM said it should be. While M squared is for you to say, okay, assuming both portfolios are exposed to the same level of risk, will I still be able to outperform the market? So M2 is used for people that don't have a fully diversified portfolio. My time is spent another 4 more minutes. There's some questions still that we haven't been able to do. And I think I have 50 questions in all on these slides. And I'm sure that the site will send out the slides. So it's just basically what the key points, what you need to know, and there's some questions to be able to bring them home. Thank you for having me today, Gloria. I think my time is far spent, and I want to believe that I've been able to add value to the candidates. And like from what Shegun said, please do not fast on that day. Sleep well the night before, because most of us have our adrenaline on the high side. We'll not be able to sleep. Force yourself to sleep, rest properly, eat well the night before, eat well the morning of the exam, and then go. And do not leave any question unanswered. There is no negative marking. When you try, and don't spend too much time on a question either. Once you think it's giving you issues, leave it and move on to the next one. When you are done, come back to it, but try to shade. Or if you know that probably won't have time, I know there are buttons that can tell you, come back to this question. So shade an answer and then click on come back to this question. What you are doing that is, in case you don't have the time to come back before your time is up, at least you have shaded something before leaving. And if you're able to go back to review it, all well and good. I wish you guys a wonderful, wonderful, wonderful weekend and success at the exam. Like Shegun said, your success is our success. Thank you, and practice as many questions as possible. That's the key to passing this exam. Practice all the questions in all shapes, form, and manner that you can get them, because that might be what will just help you to scale. Thank you very much for having me. You're having the book out again. I'm sure that Gloria will communicate what the next bootcamp is going to be, and I'm sure it's going to be against the next diet, I believe. Gloria, over to you. Gloria, are you there?
Hi. Yes, hi, Bukola. Thank you so much. And thank you everyone for being part of today's bootcamp. Like we've already promised, we are going to reach out. Some of the facilitators have already started sending in their slides. So we'll email that to everyone. And we'll also send link to the recording. It's on our YouTube channel. Then tomorrow is day 2 for the level 1 bootcamp. We start at 9 o'clock. We'll also have a morning session and an afternoon session to complete the remaining 5 topic areas. So we'll send reminders.